Entity selection and company formation, prepared for and presented at the 2017 Square One Entrepreneurship Training Program. Square One is a program of the Center for Emerging Technologies. CET is an affiliate of the Cortex Innovation Community. Square One is funded in part by the Missouri Technology Corporation.
We are talking about, here it is, the exciting realm of entity selection and kind of the early process of setting up a new company. And I understand that it's law day today. Basically, you've got 3 different law presentations. I'm representing the male gender in this whole thing. So, is that common for? Is there a lot of law people, or is this just law day with SQ1?
Today is law day.
Okay. Well, I'll be sure and warm up the audience. Make sure you're thoroughly asleep before the other 2 lawyers get a hold of you. So here's a sneak peek about where we're going. First, we'll talk about choosing the right entity. Then we'll talk about avoiding personal liability. And then I find that a lot of business owners don't really understand the correct way to sign a contract. It sounds pretty simple, but anyway, I'll give you a quick little tutorial on signing contracts at the end. But before we begin, I know you all probably are familiar with each other, but I'm not. So I understand that everyone in the room is an entrepreneur. Is that correct? Of some sort? And so how many people have already chosen the entity and formed your actual company? So a little bit over half, I would say. Okay. And then how many of you are either raising money or anticipate raising money from investors in the future? About the same again. Okay, good, but different people. Okay, so choosing the right entity. So there are a number of different types of legal entities. There are many more than these. These 6 are the most common, so I will talk about those. There's 3 principal considerations. Originally I had 2, but based on feedback from questions ahead of time, I'm also going to talk about equity. If you're going to provide equity for service providers, whether they're employees or boards, members of your board of directors or independent contractors, if you're going to give them equity, what's the best entity for that? So I added that as number 3. So limited liability. Does your entity of choice protect your personal assets from your business's problems? And tax treatment, how is your company taxed? And then equity for services. So let's say you've got a store and one of your employees isn't smart like this one and puts out that little yellow warning sign after they mop the floor. They left it wet, there's no warning, someone slips and falls. Clearly you're at fault, or your company is. So, and the patron gets injured pretty seriously and they sue. Now, are your personal assets going to be available for this plaintiff after you lose your lawsuit? That's what I'm talking about when I talk about limited liability.
You will get sued and you will lose your lawsuit. That's what happens.
Yes,
Okay,
exactly.
I want to make sure I'm clear.
Yeah, in my hypothetical, your company was at fault. They have a good lawyer. No matter how good yours is, you're still going to lose. So the question is your company, your company is going to be liable, assuming you have a company. But the question is, are you liable personally also, or is that liability stuck inside the company? Can it get to you? So that's what we're talking about when we talk about limited liability. So now let's talk about tax treatment. This is a vast oversimplification, but there's 2 ways that companies are taxed. One is pass-through taxation, and the other is double taxation. Now with pass-through taxation, the company itself is not taxed, but the income tax obligation is passed straight through to the owners. And then they record that income on their personal tax return and they pay taxes on that. In double taxation, the entity is taxed on its income, and then when the entity distributes those profits to the owners via dividend, it's taxed again. And since there's 2 levels of tax, that's referred to as double taxation. Some entities are subject to double taxation, some are passed through. And I mean, you're going to pay less taxes if you have pass-through taxation. So, and let me give you an example. I'm sure your companies make way more money than this, but just to make the math easy, I'm a lawyer and not a math person, whatever you call those people. I guess accountants, maybe, mathematicians, actuaries, but. So anyway, so we've got gross sales of 120,000, expenses of 30, so your net income's 90. That's pretty good?
We're startups. We're happy.
Oh, okay. Well, let's take a 0 off of this to have a realistic. Okay. So we've got $90,000 of net income, and we're going. So how is that going to be taxed? So if it's passed through, you're going to be taxed on your individual tax return. And I did this table long enough ago. I can't remember whether I included state taxes or not. But anyway, so your individual income tax would be $14,000 or so. So subtract that from your net income after tax, about $76,000. So that's passed through. So what if you are subject to double taxation? Same 90,000 of net income, but now you're paying corporate income taxes, and you might notice they're a little bit higher than the individual income taxes at these levels. And so your net income after taxes is 71,000. But then when your company distributes that 71,000 to you, you're going to have to pay taxes on your personal income tax return. You're going to get hit again for a smaller number, but still significant. So your after-tax income is going to be about 68,000. So here's the comparison. Net income is the same, but what comes into your pocket after Uncle Sam takes his share, and I think after the Missouri Department of Revenue takes its share, it's a significant difference. So, okay, so equity for services. So we talked about.
I do have a question.
Oh.
So in your two
Oh, there you
scenarios there, one seems to be a personal return like a Schedule C, and the other was a business return, right, like potentially a K1, I'm guessing. Was that your two scenarios?
Yes, although it'd be I mean, the one entity that we're going to talk about, or that I'm going to talk about that has double taxation is a C corporation. So its return would be 1120.
So
But
my question in that scenario is, in the one where you represented the double taxation, if you leave money in your company and you don't distribute it to the partners, because obviously you need operating income,
right.
that income is still taxed that you're leaving there as your operating income going forward, correct? It's taxed at your corporate tax rate, correct?
Right. It's taxed only that first level, though. The second level, you don't get hit till you distribute it.
If you have money left over, do the partners have to take that money, or can it just stay? No, the partners have to take it, right?
It can stay.
It can't stay.
Yeah. In fact, you probably want it to stay, you know, to fuel growth. Now,
And to be clear, he doesn't get taxed again if you leave it inside the corporation.
Correct, you're just paying, you pay your corporate tax.
It's now your after-tax income, so it remains there as, you know, retainer.
Right.
Well, right, that's how you account for it, as you
But
cash
lots of
interest.
times you see on a K1, it'll say like the recipient's amount, it'll also say then the distributed amount, right? Those numbers aren't always the same.
Right.
They were supposed to take 100, but they only took.
That's right.
that's
That's the.
a K1 is you're only going to get a K1 if you have pass-through taxation. So through an S corporation or partnership tax return. Yep. So now there's an exception though. If you leave too much cash, then you could be hit with a kind of a special tax for investment. I've never had a client that had a problem with it, so I doubt any of y'all will need to. But there was another question by someone who disappeared, I think. Oh no. Maybe change his mind. Okay. So hopefully it's not because of the low value of the first question. So if someone wants to throw me a softball, I'll answer it very expertly and you'll be very happy with it. So, okay, so equity for services. I mean, with startups especially, a lot of times you want to pay you know, some of your help with equity. Even though equity is the most expensive thing that you can use, It's still kind of, it can really incentivize people to work hard, especially in a startup that's going to grow a lot, and the upside is there. So you can, talk them into working in the middle of the night and sleeping on the cot in the office and all that kind of stuff because they've got equity. So, but with equity, your considerations are when is the tax going to be triggered and how will the income be characterized. And when I'm talking about characterizing income, is it going to be taxed as ordinary income, which is usually a higher tax rate, or is it going to be taxed as capital gains, which is a preferred tax rate? And I'm going to wait to really talk about these, about the equity for services considerations until we talk about C corporations here in a few minutes. So let's talk about, so now I'm going to go through the various types of entities fairly quickly. Apparently the most common is a sole proprietorship, and this is a single owner company. If you're doing business and you're by yourself and you didn't form a company by filing something with the Missouri Secretary of State, you're a sole proprietor. So there's no separate legal entity at all. It's simple, easy to get started. You just start and you're in business. You're a sole proprietor. You don't have to hire a lawyer to get your company set up, so all kinds of advantages. There is pass-through taxation. There's nothing to pass through, really. It's you. So you fill out a Schedule C for your company's income and losses, or your business's income and losses. You put that on your personal income tax return, and that's it. One of the worst, one of the biggest drawbacks of the sole proprietorship is that there's no liability shield. So there's no limitation of liability. So in our, our hypothetical where someone had a slip and fall and someone was going to get sued, you're going to be on the hook personally if that happens. So, and then you can't give equity because there's no company to give equity in, so you can't incentivize your employees by giving them a piece of the action. So, a general partnership, I like to think of it as a sole proprietorship with more than one member. So if you're doing business, you didn't file to create an entity with the Secretary of State, you are most likely a general partnership. Again, pass-through taxation, which is good, but again, there's no limitation on your liability. That's the biggest drawback for general partnership, is that you, in that slip and fall example, your millions in the bank are going to be subject to that lawsuit. Limited partnership, I hardly see anymore except in kind of company structures that are more complex for tax purposes. In the mid-2000s, I saw a lot of, we dealt with a lot of limited partnerships when we were creating private equity funds or venture capital funds, because that was the entity of choice. I don't do much of that work anymore, but I think LLC is the entity of choice now with even those. So I won't talk anymore about those, but just wanted to make sure that you are aware of them. I guess one thing I would say is that there's no limitation of liability for the general part. Every limited partnership has to have at least one general partner who actually runs the company. That partner is going to be subject to, or isn't going to have a liability shield, but the limited liability or the limited partners of the limited liability partnership do. So now we're going to get to a C corporation, and ordinarily, most of my clients are, let's say, Main Street businesses. So they're setting up companies that are going to kind of go the traditional non-startup route for growing their business. They're maybe going to get a bank loan, they're going to self-fund, but they're not going to bring on angel investors and venture capital, and they're not going to do that kind of high growth, rapid expansion by using professional money. And so for my clients, an LLC, even for the long haul, is usually the best form or the best entity. If you're going to bring on professional money, at some point, you're probably going to have to be a C corporation. If you're going to go public, you definitely are going to have to be a C corporation because public companies are all C corporations. So one of the things to think about if you are, in selecting your entity of choice now is, are you going to go down that path? Are you trying to be the next Facebook or something that's going to grow quickly and use venture capital money? If so, eventually you'll need to get there to a C corporation. Now, that doesn't mean you need to be one now. It might be quite a road to get there, and you may be able to save on complexity and legal fees and those sorts of things by starting out with a simpler form. So with the C corporation, you can have one owner, you can have millions of owners. There's no limit. You create the company by going to the Secretary of State's website or mailing articles of incorporation to the Secretary of State, and then you adopt bylaws, which are kind of the main governing document of how the board of directors works, how the shareholders meetings work, and those things like that. Now, the C corporation is the one entity that has double taxation. That's its big drawback. You're going to get your taxes are probably just going to be higher, and there's no way around that as far as your income taxes. So, and you have limited liability. So now let's talk for a minute about equity for services. And Christy, how much time do we have?
We have about 45 minutes.
Oh, okay, plenty of time. Okay, so I'm going to talk about, there are a lot of variations on how to incentivize employees and other people by either giving them actual equity or giving them bonuses that act like equity, like phantom stock. And I'm not going to talk about phantom stock, so the two kind of categories of incentives that I'm going to talk about are stock grants and then options. And these I'm going to talk about them, at least initially, in the context of a C corporation. So in a stock grant, the company just grants the employee or independent contractor stock in the company. And so everything I say is going to be super simplified and generalized. So this stuff is extraordinarily complicated, and it involves tax law that's above my pay grade and my mental ability to even think about. So, but just kind of give you an introduction to this stuff. So there are so with the grants, there is just a grant where now you have stock. Yesterday you didn't own any of the company. Now you're basically a full owner of the company, and you've got common stock in the company. So when you get that kind of a grant, which would be wonderful to get, no strings attached or anything, you just now have an ownership interest in the company, you are going to be assessed income tax on the day that you are granted that stock. And your income taxes are going to be characterized as ordinary income, which, as I mentioned earlier, is not good. It's going to be subject to payroll taxes and withholding, and it'll be taxed as ordinary income. So now another type of stock grant is a restricted stock grant that's subject to vesting. Now when a grant of stock is subject to vesting, the grant itself doesn't trigger taxable income, but when that vesting time actually lapses and the stock vests, at that point that's going to trigger income on the grant to the stock, and you're going to owe as ordinary income tax in the amount of the fair market, or the taxable income is going to be the fair market value of the stock on the date that it vests. Now, if you're in a high growth startup and you get stock that vests in a year, if things are going well, it's going to be worth a lot more next year when it vests and you're hit with the income tax than it is today. And so that's something to think about. And the IRS gives you a handy way of dealing with that called an 83B election. And basically what that does is it lets you take the tax hit on the value today rather than later. Of course, anything the IRS gives you, there's going to be a huge either gotcha or a string attached. And that huge gotcha is if your stock doesn't vest, you've still paid your taxes, and that's just too bad for you. gave a gift to Uncle Sam. So, okay, so those are stock grants, and now we'll talk about stock options. So there's two different types of stock options, incentive stock options and then non-qualified or non-statutory stock options. And incentive stock options are given only, you have to be an employee. You can only give incentive stock options to employees. And they have the advantage of both delaying when tax is triggered and characterizing that tax or that income as capital gains instead of ordinary income. So when everything works right, it's great and you're going to save on taxes. So the downside is that in order to get the capital gains treatment, there are 2 holding periods that you have to comply with. And a lot of times incentive stock options aren't actually exercised until there's a liquidation event like an IPO or something like that, which means that you don't hold the stock for the amount of time that you're required to qualify for the capital gains treatment. So anyway, so incentive stock options can be great tax-wise, or they could be a lot like non-qualified stock options. So with the non-qualified stock option, income is triggered at the fair market value minus whatever the strike price is, which is usually going to be the fair market value of the day that you were granted the option or higher, and then it's taxed as ordinary income. So now that everyone's chin has hit the floor or the table, any questions about incentive stock options that are non-qualified? Yes.
This is only if you have a corporation, right?
Yes and no.
Because I watched the video and they were talking about how these stock is only for corporations, but LLC is something different. I just was wondering what the difference is as far as offering.
Yeah, the stock grants of corporations and grants of equity in an LLC are pretty similar. With options, there's no such thing as an incentive stock option for an LLC. So if that's what you want to grant your employees, that's going to be off the table. Option type awards are more complicated with LLCs, which is one of the drawbacks for startup companies that are going to incentivize want to incentivize their people with options. Although with the and one of the biggest reasons is that LLCs don't have shares of stock. I mean, with the corporation, you issue certain shares or whatever. With LLCs, you basically have a percentage of ownership. In startups, a lot of times that drawback is sort of overcome by issuing units. And that's a way of quantifying pieces of ownership similar to a share of stock. So if you've got, 1,000 units out of 100,000 that have been issued, then you've got whatever percentage ownership of that it is. So, yes, sir.
If you are issuing percentage of ownership to partners to buy into the company, that's not a tax event, correct? If you say, I'll give you 10% of my company for $20,000, that's not an event at all on either side, right?
Yes, if they're paying, or it's not. No, you're correct.
Yes,
Although there's that's if they're paying for it. Now it's common to issue a membership interest in exchange for services.
in a scenario where it's an equity stake in the service stake, right? You do this amount of work and you get this amount of money for this amount of ownership.
Right, and that issuance of a membership interest in exchange for a service is going to be taxable.
Because that's like income, right? You trade it like almost like personal property for it.
It's more like compensation, so it's like salary or bonus. So let's say
you to work for the company, right? They're saying Yeah, I'm going to work for you and I'm gonna give you $20,000, right? That's, they're paying to work there. It's not the other way around.
I'm a little
You
confused
have a
about the
person who
question.
says, I will work for you.
Uh-huh,
I will be your CFO,
right,
and here's $20,000.
right,
I want 10% of that. They
right.
gave their labor and their money for a percentage of ownership. That does not create a tax, right?
It depends. I mean, part of their equity issuance is going to be in exchange for services, and part of it's going to be in exchange for the money.
But then
So,
within that company would have to have a value for you to value what you gave them, right? They gave you labor, and you gave them something, or you gave them was zero.
No, it would have to be valued. It doesn't,
Who determines the value of a company?
I'm looking.
there's an entire valuation process. But
You just
also
opened up
from-
university level.
So also, from
Class.
the takeaway on this,
Sorry.
I would just say the takeaway on this is like, let's go back to the simplified scenario. I say I'm gonna work for you and you give me, instead of paying me cash,
Right.
or in addition to paying me cash, you also issue me stock. Depending on when that vests, correct me if I'm wrong, because I'm not a lawyer or an accountant, that creates a taxable event for that individual.
And for the company, because I just had an expense and that person had income.
Yes
Yes.
Yeah.
and
So what
no.
we really need
It's
to
much.
hear is
It's
that that
yes,
person
generally.
wasn't- It could be, in issuing the stock, you could create a taxable event for which the person has received no income, and they still have to shell out the money for the taxes.
You would have to have some valuation of
You
what that
will,
is
the minute
worth,
you
right?
issue stock, you're putting a value on the company. The
Right.
minute you issue stock, you're putting a value on
Sounds
it.
like a bad idea.
Well, it's not necessarily, I mean, one of the takeaways from our speaker last week, who remembers what Claire Flowers said?
She wishes she would have.
She wished she would have leveraged her equity earlier to get the talent that she needed.
But then we've also heard people say the opposite.
Absolutely,
Yeah,
these
so
are
Claire
personal
was
decisions.
definitely right on that.
These are personal decisions. This is just one tool in your toolbox with regard to getting talent or resourcing your company. But whomever you're offering that to needs to understand what the tax implications are for them. That's not your responsibility, but I would say as a startup
It
founder,
does seem like it's your
it is one of your
responsibility
things
to
that you need to say, go talk to your lawyer, go talk to your accountant. Because especially if they think sweat equity is gonna convert into something, that's still is something that's taxable and they haven't received anything in terms of actual cash. Please, Harry, jump
But
in.
maybe it would help simplify this a little bit if we just acknowledge that, you know, when you're first starting out in a startup company, generally speaking, you've got a lot more equity to spend to encourage people to participate than you do cash. Right?
Correct, yes, correct.
Okay, so that's true. And then let's fast forward and assume that the company is successful. Then you're also going to find that that was the most expensive way
To get
to
$20,000.
pay somebody. You're going to find that was a very expensive way to incentivize people at the end of the day. And you got to be comfortable with that. Because at the time that you were doing it, you didn't have any cash to share really.
And you needed stakeholders, you needed
And you
people to work,
need
yes.
people to move. That's the
Yes.
key
That's
point.
the number one, is you want people incentivized
That's-
to work hard.
Thank you. That is the key point. In order to
You can't
move
do
your
it.
company forward, you need to have people buy into your vision.
Right.
And you need to incentivize them to do that. And you don't have capital to do it, you know.
It's unfortunate that it created
You know,
a
so-
taxable event for them by
Well-
participating, right?
Well, it doesn't have to though.
I agree.
It doesn't have to. In other words, if you basically do an option, it doesn't create a tax if it's a qualified plan. And if you handle your 83B election properly, it doesn't have to, and they actually put in the value of the stock that they received, then that's not a tax. The 83B election is to the FDA, or excuse me, to the IRS. I actually paid fair value for the stock. That's what the 83B election is essentially saying, right?
Mhm.
So if you're doing that, then, you know, the IRS may come back at some point and say, oh, well, that company couldn't possibly have been worth that much, that little back then, in which case you better have a strong argument, like, well, we hadn't licensed our technology yet.
We were $400,000 in debt, yeah.
Yeah, right, we were actually losing money at that time, right? So,
$400,000.
yeah, so, and those arguments are actually pretty Well, I don't know how easy or strong they are to make. They are they are usually very successful, in my experience anyway.
So to finish, and I'll get to your question. The issuance of equity obviously has tax implications that can be complicated, and I wouldn't do it without consulting with a professional. So, and including a CPA to help you with the proper valuation. And you also want to have the backup for how you determine your valuation for that instance where you need to talk to the IRS about it after the fact. So, another
So a
question?
couple, kind of a two-part. So is equity always stock? I mean, when you're saying stock, if you're giving equity to someone, is it you're giving them stock?
Yes, in a corporation, equity is going to be stock, and in LLC, it's going to be a membership interest.
Different language.
Yeah.
So knowing what entity you're having, so
Yeah.
there is no stock in an LLC. There are units in LLC.
Okay. And is it sort of like anything where you decide that? So if you're giving like units or you're giving stock, it's like say that it can be either long-term, that they're gonna get paid when such and such happens? Is it like a tier program where, or if all of a sudden you start to offer them a salary once it gets to a certain point? Is that sort of, I guess, a decision that you make when you make that?
So maybe
Agreement
you're
with
asking,
them?
how do they get paid? for
Yeah,
their
I
equity?
guess so.
So the way they get paid is when the company is then bought or is publicly traded. Because then somebody's either coming in and buying all the stock, in which case they're going to buy out the employee as well. Or if the company goes public, then the employee, after a lockup period, is allowed to sell their stock on the public exchange, right? So that's how people ultimately get value for the equity that they took. And as far as I know, there are no other ways.
Well, there's one more. I mean, if at some point the company, either publicly or not publicly traded, has enough cash that starts making distributions, they get a distribution that's proportional to what percentage they own too.
Fair enough. Yeah.
And
I
it could be
guess-
bought back by the company technically,
Yeah,
but there are
dividends a little
taxable
bit old
events,
school for me, I have to say.
even when they're not generating revenue, earnings off of that. Which is why you need, yes, you have a certain amount of discretion in structuring those compensation agreements, which is why you need a good lawyer and a good CPA to understand what the consequences of making those decisions are, so does the other part. In the interest of time, we're gonna move on to S Corp.
Alrighty. So if you are what I think of and describe as a high growth startup, where you're going to go through that process of raising money from angels and hopefully venture capitalists at some point, S corporation is not going to be for you. So if you're more of a Main Street business where you're not going to be raising that kind of money, then an S corporation could be really good for you because it gives you the benefit of pass-through taxation, even though you have a corporation. So the reason that there's two reasons that S corporation is generally not good for high-growth startups. One is you can only have up to 100 shareholders, and they basically can't be entities. They have to be individuals in some trusts, some nonprofits, which means that most of your professional investors who are going to want to invest through an entity aren't going to qualify as potential owners or eligible shareholders. So the other reason is that there's what's known as the single class of stock rule with S corporations. So S corporations, their stock, every share has to be treated equally as far as distributions. And when you're raising money from professional sources, they're going to probably want preferred stock, these sorts of things that just aren't allowed with S corporations. So if you're like a professional services company or something like that, where you're working for the company, you're not going to be raising money from professional investors, S corporation or an LLC, I'll get to this in a second, but an LLC that's treated as an S corporation could be a great choice for you, but if you're going to raise money from professionals, it's not. So now let's talk about limited liability companies. which in my world is definitely the most common entity. Most companies start as LLCs, even if they're converted later to a corporation, because as they grow, their investors want them to be a Delaware corporation or whatever. A lot of companies start out as LLCs. So you can have single or multiple owners. You create the company by filing a document with the state. They have limited liability, which is great. One of the things about LLCs that's just unique is they can elect how to be taxed. So if you're a single member LLC, you can elect to be taxed like a sole proprietor. If you're a multi-member, you can elect to be taxed as either C corporation or an S corporation. So, so that gives you the benefit of the flexibility of an LLC, and they are very flexible as far as how you can structure them and whatnot with the tax treatment that you want. Yes, sir.
One thing I learned about the state of Missouri is that even as an individual, you can be elected as an S corp.
Right.
Yeah.
Yep.
You just have 75 days to pull the trigger.
Right. Yep. So, and if you're, so I mentioned that if you're a single member LLC, you can elect to be taxed either as a sole proprietor or as a C or S corporation. If you're multi-member, your choices are as a partnership or a C or S corporation. So one of the great things about an LLC is, I mean, in Missouri, there's several great things. For one, they're very inexpensive to set up. I mean, $50 fee is the filing fee. In Missouri, there's no follow-on requirements as far as filings. You don't have annual reports like you do with corporations. There's no requirements for board meetings or shareholder meetings like there is with corporations. So it's a really simple company to maintain. And I see this more with real estate people who want to be anonymous, but it's also possible to be anonymous with a LLC, where you really can't be with a corporation. So, and we kind of already talked about equity for services pretty thoroughly, but one thing about LLCs, and in particular LLCs that are taxed as partnerships, with the when someone contributes services in exchange for a membership interest in a limited liability company, that is going to be taxed as the value of what they're receiving is going to be taxed as ordinary income in the year that they provide the services. And so now we have, let's say you have two founders, one's bringing money to the table, the other is bringing services. So someone's contributing, say, $100,000, the other one's just going to run the company and they're providing services. So assuming that the value of the company is, assuming since they're each getting 50% ownership interest, the value of it's actually $200,000, you've just triggered a lot of income on that service partner's tax bill, even though they get no money for it. So with partnerships, there's a nice alternative, which is called a profits interest. And so if you issue a profits interest, what that partner gets is whatever percentage of profits that they're issued plus their percentage of increase in the value of the company. So if the company's worth, say, $200,000, when you found it and you give the service partner a profits interest of 50%, then they'll have an interest in 50% of the profits along the way, and then when there's a liquidation event or the company is sold, then they will also have, say, 50% of the amount of the increase in that value. So they wouldn't share in the that $200,000 of initial value, but so anyway, that's a good way of incentivizing service partners without making them take a big tax hit. Any other questions? Okay, so let's talk about personal liability really quick. With companies, there's usually there's at least 3 ways that you can find yourself as an owner on the hook for your company's liabilities. We've talked a little bit about, you know, the slip and fall situation where the company has a shield where it shields the owners against the company's obligations. So in most circumstances, that shield holds. In some, it doesn't, and I'm going to talk to you about those danger areas, how to avoid that. Personal guarantees, particularly for young, growing companies that don't have a history of operations and they don't have a large balance sheet, you know, with collateral or whatnot. For loans, the owners often find themselves being required to personally guarantee the obligations of the company. Once you sign on as an individual to be responsible for the company's obligation, you're going to be on the hook. So, and then you're always liable for your own torts. So first, piercing the company veil. So basically, this is kind of it's a judge-made solution to the problem of people abusing the corporate entity to basically defraud the public. So you form a shell company. The company does all kinds of bad stuff. It doesn't really have any assets, and then it disappears. And then the owners say, "Well, you can't sue me. It's the company's obligations and not me." And so, and that's a real kind of extreme example, but that's the sort of thing that courts were responding to when they created this piercing the corporate veil or piercing the company veil approach. So there's usually some sort of fraud, or you're providing or creating an undue risk to the public, and that's the circumstance where this would come into play. So the things that courts will look at is, did you adequately capitalize the company when it was founded in order to meet the obligations that you would expect toward the public or whoever? And then with corporations, if you have a corporation, did you treat the corporation like a real company, or did you just pretend that it didn't exist and treat it like it was your own, like the business was your own? So for instance, with the corporate formalities, did you hold the shareholders meeting that the law requires every year? Did you elect directors and officers? Did the directors actually approve important actions that the company took? And most importantly, did you use the company's funds as if they were your own funds? So did you have a separate bank account for your company's expenses and income that's separate from your own personal account? So when you create an LLC or a corporation, under the law, it's a separate legal person. And if you treat that company like a separate legal person from yourself, then you shouldn't have troubles with this piercing the veil. But I want to make sure that you're aware of that. So when you're setting up your accounting system and you're thinking, well, I don't want to have an extra bank account and I don't want to pay an accountant for these books, it's a big pain to submit expenses to the company to get reimbursed as if I were an employee. There's extra paperwork and stuff, but think of that company as a separate person, and you'll be in good shape. So, and then here's some tips that I pretty much already covered, I think. 10 minutes? Oh, that's more time than I thought. Good. So be sure to keep separate bank accounts, and your accounting should be in good shape so that you're tracing all of the income and expenses and making sure that any kind of transactions between you as the owner and the company are recorded appropriately. Never pay a personal bill from the company. If you need the money from the company, make sure it's distributed to you and your bank account appropriately, and then write the check. And then I mentioned corporate formalities. Another important thing is to buy appropriate liability insurance. So one of the things that courts will think about in determining this corporate veil piercing analysis did you appropriately protect the public from the sorts of liabilities that are going to be obvious? So in the case of our slip and fall, I mean, you should have had commercial general liability insurance on your business. If you did, it probably won't even come to this anyway because your insurance will take care of it. Oh, and then the last thing is, I've said this before, but make sure you sign contracts correctly, and we'll get to that in a sec. So personal guarantees, I did already talk about. If you personally guarantee a debt, you're going to be on the hook personally, even if it's a company debt. So these are circumstances where I see people required to personally guarantee stuff: a bank loan, real estate leases and other leases, equipment leases, or sometimes a copier lease. Your merchant account, credit cards for your business, probably you're going to have to personally guarantee those when it's a young business. Excuse me. And then sometimes other contract parties are just going to require you to do that if they don't have enough faith in your company's ability to perform. And you're always going to be responsible for your own actions. So we started out with an example of a slip and fall. One of your employees mopped a floor, didn't put out the sign, someone slipped, fell, sued your company and sued you. Were you going to be responsible or not? If you were the one mopping the floor, you're probably going to be responsible. If you're driving, even if you're driving on behalf of your company and you cause an accident, you're probably going to be on the hook for that, as well as probably the company too. So, but you're always responsible for your own actions. All right, so the final topic, how to sign a contract. So, as I mentioned before, I've just seen a lot of contracts that just aren't signed correctly, and that sounds simple. I mean, what's there to it? Just sign at the dotted line, right, where the X is. But the most important thing, or one of the most important things, is making sure that the correct legal persons are signing the contract. So if your company, I mentioned before that under the law, a company, a corporation or an LLC is considered to be a separate legal person. So if that's the legal person that is entering into the agreement, then that LLC or that corporation should be the party to the agreement and not you. If you're the correct party to the agreement, then you should be the one. Where that gets complicated is companies can't do anything without people doing it. So since you're the one running the company, you're going to be the one signing it. But we want to make sure that it's clear that you're signing on behalf of the company and not on your own behalf. So the introductory paragraph and the signature blocks should match completely. So the name of the company at the top in the first paragraph, and the name of the company at the bottom where you're signing it should match the same. So here's a sample. Oh, thanks. Here's a sample. I'm surprised it didn't go down to 4 before I saw it. Here's a sample introductory paragraph. So if I have a company called the Contracts Guy LLC, and then I'm entering into a contract with that company as Brian Rogers, this is a good way for your introductory paragraph to describe those. So we've got a company and an individual. And then here's the signature blocks for that. So you can see that it's clear that the actual party to the agreement here is the Contracts Guy LLC, and I'm signing it on behalf of Contracts Guy LLC, and that's why it says by. And then I've also printed below that what capacity I'm signing that. And I'm the manager of the LLC, so I'm signing it in that capacity. And then here's an example of an individual signature block. So if I'm signing on my own behalf as an individual, that's the way it'll look. And I did the Contracts Guy in all caps. That's kind of an old convention that that's kind of dying out. I don't really do it that way anymore, but the old convention was if you name a company that was formed by filing something with the Secretary of State, you put it in all caps in the initial paragraph in the bottom in the signature block. So So make sure the correct legal persons are signing the contract, make sure the introductory paragraph, signature blocks are exactly the same, and then make sure you know the correct legal entity. It sounds intuitive, well, of course you know, but I mean, I've seen, you know, large corporations that might have hundreds or even thousands of affiliated entities, and trying to find the right one of those that should be the party to a particular contract could be difficult. And I've also seen a lot of instances where entrepreneurs, they maybe don't have a company and they're actually just doing business as a sole proprietor, and they'll sign, you know, DBA something or another, and they'll sign with as their DBA instead of as themselves, or they have a company that's doing business under a different name, under a DBA, and they'll sign as the DBA instead of the company. In signing contracts, it's the legal entity and not the DBA that should be in the introductory paragraph and in the signature block. Now, you can have both, the DBA and the legal name, but never just use the DBA. And then make sure the right people are signing the contract. So, and here I've got a few examples of contract signatures. This is an example of a corporation, and you can see I'm signing as the president of the corporation. Here's a limited liability company that's managed by a manager. We didn't really cover this, but there's two flavors of limited liability companies. There's ones that, one flavor is they're governed by the members, and then the other is manager managed. In this case, it's manager. So the only difference in the signature block for member managed is that the title changed to member. And then individual. And if there's any other lingering questions, I'd be happy to answer them.
We have time for one.
Who's the lucky questioner? No pressure, but this better be good. 'Cause
It's short. Is there any reason not to also put, if you're signing on behalf of a company or an LLC, to say not individually?
I don't think so. If you've done the introductory paragraph correctly and you do the signature block
So you
correctly,
have all the names match up, so it's the same LLC, it's the same thing, and then where it says actually by, Justin Swift, managing member, not individually.
right? I don't see any benefit. If you like, there's two ways to approach legal issues. One is you rely on suspenders or your belt, and the other is you wear both. So for me, I'm a belt or suspenders guy, and not both. So some people might prefer that. I see it sometimes, but I don't think you're in danger of being on the hook individually if you do your signature block right.
So if we take the analogy from last week, you want pants that cover your ass, and then you're gonna want a belt and suspenders, or belt or suspenders. Thank you so much.
Sure, my pleasure.